December 2008. The office is hushed, tension thick in the air. Bernie Madoff sits behind his desk, the weight of impending doom pressing heavily on his shoulders. He knows that everything he has meticulously constructed over decades is about to unravel. As the door swings open, the truth is poised to crash down. How did Bernie Madoff's empire of deception come to such a catastrophic end? It's 1960. The bustling streets of New York City are alive with ambition and dreams. Amid this backdrop, a young and determined Bernard L. Madoff lays the foundation for what will become Bernard L. Madoff Investment Securities, LLC. The company is poised to ride the wave of financial innovation, capturing the imaginations of investors eager for success. Fast forward to the 1980s. Madoff is no longer just a name, it's a promise. A promise of returns that seem almost too good to be true. By 1982, Madoff begins using futures contracts on the stock index, a cutting-edge move that bolsters his reputation as a financial wizard. Investors are drawn to the allure of consistent, strong returns, even as the market sways unpredictably. To ordinary people, Madoff's firm is a beacon of stability in a volatile world. At its height, the scheme defrauds investors of approximately $65 billion, a staggering figure that sends shockwaves through the financial community. But beneath the surface, cracks are forming, hinting at a truth too devastating to ignore. The year is 1990. Bernie Madoff stands at the pinnacle of success, his firm a fortress of financial prowess. Investors clamor for a piece of the action, seduced by returns that defy market logic. Madoff's secret, a scheme so audacious it seems invincible. He crafts an image of unshakable stability, leveraging his reputation as a financial savant. Investors, driven by a fear of market volatility, flock to him, trusting in his promise of unwavering returns. The allure is irresistible, but beneath the polished veneer, deception is woven into the very fabric of his operations. Madoff's genius lies in his ability to exploit the era's technological shifts. The transition from fractional share trades to decimals cuts into legitimate profits, but he adapts, transforming this challenge into an opportunity. His empire thrives, built on the illusion of innovation and consistency. By 2001, Madoff consolidates his control, establishing a liability company with himself as the sole shareholder. This move fortifies his grip on the empire, allowing him to maneuver with unparalleled freedom. His brother, Peter Madoff, takes on the role of compliance officer, a mere facade in the grand illusion. As the years roll on, Madoff targets charities, knowing they are less likely to demand sudden withdrawals. The scheme expands unchecked, as investors ignore red flags in the fervor of a bull market rush. Madoff's operation thrives, untouched by the scrutiny that might unravel it. But in the shadows, a storm brews. Redemption requests begin to mount, a whisper of the chaos to come. The empire stands on the edge of collapse. In December 2008, the Madoff offices are a flurry of activity. Phones ring incessantly, and the tension is palpable. Redemption requests flood in, totaling a staggering $12 billion for the year, with $6 billion withdrawn in just the last 3 months. It's a tidal wave that threatens to drown the empire Madoff meticulously crafted over decades. Investors, once seduced by the promise of consistent returns, now panic, seeking to reclaim their funds amid the market turmoil. Madoff sits at his desk, surrounded by financial statements that tell a story of deceit and desperation. The promised returns of 18% to 20% had always been a mirage, a carefully orchestrated performance that now teeters on the brink of exposure. The truth is that Madoff's firm holds only $17 billion in assets against liabilities nearing $50 billion. The math is unforgiving. As the pressure mounts, Madoff calls a meeting with his sons, Mark and Andrew. In a moment of rare candor, he reveals the truth. The entire operation is a lie, a Ponzi scheme of unimaginable scale. The revelation is a seismic shock, shattering the facade of success that had cloaked the family for years. The sons, stunned and betrayed, face a moral crossroads. That night, Madoff's confession reaches the ears of federal authorities. The next morning, December 11, 2008, Madoff is arrested, his empire collapsing in a cascade of legal and financial ruin. The news spreads like wildfire, igniting outrage and disbelief across the globe. For the thousands defrauded, the impact is devastating, their financial futures in tatters. But as Madoff sits in his cell, the world outside grapples with the fallout. The financial industry is rocked to its core, trust eroded, and questions unanswered. How deep would the repercussions run? In the days following Bernie Madoff's arrest, shockwaves ripple through the financial world. Investors scramble to assess the damage, realizing the staggering $65 billion Ponzi scheme has obliterated their fortunes. The numbers are stark, $50 billion in estimated losses, with victims receiving only $1 billion back so far. Trust in the financial system is shattered, leaving institutions and individuals reeling. As the legal proceedings unfold, Peter Madoff, Bernie's brother and the supposed compliance officer, is expected to appear in federal district court in Manhattan. He prepares to plead guilty to criminal charges, his life irrevocably altered by the scandal. The courtroom becomes a theater of accountability, as victims and onlookers seek justice. Meanwhile, the hunt for recovery intensifies. The largest single forfeiture recovery stands at $2 billion, a drop in the ocean compared to the total losses. Legal settlements continue with $6 billion resolved on a single Tuesday. Yet the gap between what was lost and what can be recovered remains vast, leaving many to wonder if true restitution is possible. Beyond the courtroom, the financial industry faces a reckoning. Increased scrutiny on hedge funds and investment firms becomes the new norm, as regulators tighten oversight to prevent another catastrophe. The public, once enamored by the allure of consistent returns, now eyes investments with suspicion. But as the dust begins to settle, one question lingers: who would emerge to fill the void left by Madoff's fall? Bernie Madoff's Ponzi scheme left a scar on the financial world that won't soon fade. His operation thrived on deception, exploiting investor trust and market volatility. The illusion of consistent returns masked a $65 billion fraud that devastated thousands. Madoff's collapse exposed vulnerabilities within the financial system, shaking confidence and prompting a reevaluation of trust in investment practices. The fallout was not just financial, it was a wake-up call. Investors, regulators, and institutions were forced to confront the uncomfortable truth. Unchecked greed and insufficient oversight had paved the way for disaster. As the industry grapples with tighter regulations and increased scrutiny, one question remains: would the lessons learned be enough to prevent the next catastrophe? Bernie Madoff sits in his cell, a man whose deception unraveled an empire. The SEC's charges against him had revealed a $65 billion illusion, shaking the financial world to its core. Investors, once blinded by the allure of consistent returns, now face a stark reality. Madoff's scheme exploited both trust and fear, leaving a legacy of financial ruin. In the end, the collapse of his Ponzi scheme served as a grim reminder of unchecked greed. The world wonders, had the lessons truly been learned?